Just entered 2024, CNA's US stock market fear and greed index soared to 76%, reaching a level of extreme greed. This reflects the public is very optimistic to the financial market performance for 2024. However, the wealthy always prefer to bet against the retail investors, as retail investors are always wrong. At the end of December 2021, 2 years ago, the fear and greed index soared to 65%, indicating that investors were very confident about 2022. But unexpectedly, over the next 12 months, investors were surprised as the US stock market fell by 23%. At the end of 2022, the fear and greed index dropped to 35%, pessimistic to the stock market in 2023. Over the next 12 months, investors were once again surprised by the stock market, which surged by 25%. What will happen in the next 12 months? Will the US stock market experience a major downturn contrarian to public expectations? In today's short video, I will review 3 key factors that will lead to a major crisis in the US stock market in 2024. Hello everyone, I'm Chee-Ming Wong. My channel mainly combines my 12 years of experience as a senior private banker and the investment wisdom learned from the interactions with over 100 billionaires, helping you build and apply the investment strategies and mindset commonly used by the wealthy, so that you can create your own wealth worth tens of millions or billions.
The current situation of US stocks is very different from a year ago. The market is overly optimistic. Most investors in the past month have been completely convinced by the view that the US economy will achieve a soft landing, believing that the economy will not fall into recession, and that interest rates will drop significantly in the next year. As a result, they have flocked to the market, pushing the stock market from 4,100 points in October to 4,800 points. However, the problem is that the current general market expectation that the economy will avoid recession and continue to grow, and that interest rates will continue to fall due to slowing inflation, may actually be setting the stage for a future setback. If these expectations are not met, stocks will obviously fall sharply. But worse, even if these expectations come true, stocks could still crash. Let's look at the current market expectations. As of December 29, 2023, the S&P 500 index reached a high of 4,788 points. According to CME Futures market predictions, the Federal Reserve will cut interest rates 7 times by December 31, 2024, meaning the Federal Reserve's fund rate will drop from the current 5.25, 5.5 to 3.25, 3.5, or 3.75, a decrease of 2 percentage points. The market expects that the US price-earnings ratio is about 20 times, with expected earnings growth exceeding 12%, higher than the average value of 10%, which implies that the US economy will achieve higher than average growth. But we must ask ourselves whether the US will really cut interest rates so quickly and significantly. This is crucial because it is the basis for the stock market's rise from 4,100 points in October to nearly 4,800 points now. Without this basis, the stock market would revert to its original state. Let's assume that if the economy continues to be stable and positive this year, as it is now, with the market remaining strong, unemployment rate maintaining at a low level of about 3.7%, supply growth rate also remaining around 5%, and retail sales still booming. Based on historical experience, the Federal Reserve rarely cuts interest rates significantly under these circumstances, especially considering that rent, which accounts for 30% of inflation, is still growing at more than 6%. Additionally, with supply growth at 5% and a tight labor market, the Federal Reserve is unlikely to overlook the risk of inflation rebounding. Therefore, cutting interest rates 7 times within a year to reach 2% is very unusual. If the Federal Reserve does not show an intention to cut interest rates before the end of the first quarter, the market is likely to be very disappointed, and the stock market may suffer a severe blow. Of course, the above is just an assumption of good economic development. In fact, the Federal Reserve Chairman stated at the beginning of December that the growth rate of the US economy has exceeded its potential level. This means that he should have raised interest rates, but he chose a more moderate approach. This implies that due to the lag effect of interest rate hikes, the economy is likely to enter a slowdown phase in 2024. However, the expectation of a 2% rate cut within a year means that the economy must show signs of a severe recession. From 1980 to the present, whenever there are signs of a severe recession, the Federal Reserve adopts measures to cut interest rates by more than 2%. In these cases, the stock market often falls sharply. 1990, 1991 halved in 2000, also halved in 2008, and fell up to 40% in 2020. When the Federal Reserve cuts rates rapidly, it usually causes investor unease and panic. Why? Because in such situations, investors will not consider the benefits of rate cuts, but will worry about a significant weakening of economic growth momentum, which could have a major impact on companies' profitability and cause market panic.
So, the key question is whether the US economy will really show signs of a sharp recession in 2024, prompting the Federal Reserve to take significant rate-cutting measures. To answer these questions, we must first understand why the US economy maintained strong growth in 2023. We need to examine whether the factors supporting the economy will still exist in 2024.
The US economy is primarily driven by consumption, accounting for about 70% of the gross domestic product. When consumer confidence is high, the economy usually performs very well. To maintain consumer confidence, 4 conditions are needed: a stable job market, continuously growing income, confidence in the job market, and a significant amount of available consumer credit. In 2023, the US unemployment rate remained at a historically low 3.7%. Real disposable income growth was 3.8%. The employment participation rate of middle-aged people reached a 20-year high, and most families achieved real income growth. It was this confidence in the economic outlook that led to people using credit cards for consumption. In 2023, credit card debt climbed to a historic high of $1 trillion. And these factors together drove the US economy to grow at a rate of 4.9%.
There are 3 main factors that may directly impact the core of economic growth, making it unlikely for the US to achieve a soft landing as expected. The growth rate of US consumer spending is likely to slow down.
In the US, credit-based consumption is a key driver of the consumer market, and this consumption behavior mainly depends on banks' credit cards. Whether banks provide consumer credit depends on an individual's credit score. The higher the credit score, the greater the likelihood of obtaining a loan. This score is closely related to an individual's income and monthly spending and repayment. During the pandemic, the US government froze the repayment period for a large number of loans, artificially raising the overall personal credit score in the country by 20% to 676 points, exceeding the 670 points usually considered as a good credit level. As a result, many financial institutions were more willing to provide consumer credit on more lenient terms during this period. This is one of the reasons why credit card spending increased significantly and credit card debt reached a historic high of $1 trillion between 2022 and 2023. However, as related policies gradually phased out in mid-2023, including the resumption of student loan repayments in October 2023, Americans began to feel increasing repayment pressure. The bad debt rate for credit cards rose significantly in the third quarter of 2023, with expectations for an even worse situation in the fourth quarter. Groups with lower credit scores were particularly affected. According to VandyScore data, the bad debt rate for groups with scores between 300 and 550 points rose sharply from 7.6% in April to 9% in October, exceeding the peak during the pandemic. The rate for the group with scores between 550 and 650 also reached the highest level since the pandemic. These two groups actually make up 70% of the American population. VenDayScore CEO Silvio expressed concern about the personal credit outlook for 2024 in December. He believes that in the worst case scenario, up to 70% of consumers may be unable to resume normal loan repayments, which would have a significant negative impact on the credit market. Considering the ongoing decline in credit quality, banks will naturally start to tighten consumer credit. According to the latest survey by the Federal Reserve, more and more banks are tightening their consumer credit policies. The tightening rate has risen from less than 10% at the beginning of 2023 to 30% in the third quarter. Therefore, we can expect that up to 40% of Americans might face tightened personal consumer credit in 2024, while they also need to pay higher repayments. In this context, expecting a thriving consumer market in 2024 is clearly unreasonable.
The second factor is the deteriorating labor market.
Businesses will face higher financing costs in 2024, which will have a negative impact on the labor market. Over the past year, corporate financing costs should have become more difficult due to interest rates far higher than the 15-year average, but strangely, this did not seem to have any significant impact on the economy. The reason behind this is that most businesses issued a large amount of low-interest bonds and obtained cheap funds to support their operations during the period of loose monetary policy from 2020 to 2021. At that time, due to the pandemic and government support policies, junk bond yields fell to a historical low of 4% to 4.5%, allowing businesses to lock in a large amount of low-cost capital. In the short 2-year period from 2020 to 2021, the issuance of high-yield bonds approached $1 trillion. In the short span of 2020 to 2021, the issuance of high-yield bonds approached $1 trillion, setting a historic record. Therefore, in reality, only a portion of the debt needs to be refinanced at the current higher interest rates. This explains why there is a lag effect in the impact of monetary policy on the economy, especially in this cycle. Since mid-2023, the US's financing needs have gradually increased. It is expected that in 2024, a large amount of junk bonds will mature, requiring financing and rollover, involving an amount close to $250 billion, an increase of 1.5 times compared to 2023. As 2024 enters its peak period, the cost of refinancing is likely to further rise to above 8.5%. In such a deteriorating operating environment, high interest costs will become a heavy burden for most companies, leading to more companies struggling to obtain financing or even facing bankruptcy. At the end of 2023, as the peak period of financing gradually approached, the number of cases applying for bankruptcy protection in the US had significantly increased to the highest in 13 years. This trend is expected to worsen in 2024. Affecting businesses across various sectors, including energy, telecommunications, consumer retail, healthcare, technology, automotive, real estate, construction, entertainment, media, transportation, logistics, and financial services. This will have a significant impact on the US economy. Facing substantially increased interest expenses and unchanged revenues, companies' profitability will be challenged, forcing them to seek cost reductions to maintain profitability, thereby reducing labor demand. Additionally, as medium and large enterprises increasingly adopt artificial intelligence technology to reduce costs, this shift will have a negative impact on the employment market in 2024. Since AI technology officially entered the market in November 2022, after a year of development, these technologies have begun to mature. In recent months, a large number of AI companies have launched applications to replace manpower in various industries. According to estimates by Goldman Sachs, currently about 25% of jobs in the US could be completely replaced by artificial intelligence. This is particularly evident in large enterprises in sectors such as finance, publishing, legal services, industrial production, and agriculture. These companies have actually begun to widely adopt AI to replace manpower by the end of 2023.
The third factor is banks' cautious attitude towards lending intensify.
As for bank loans, due to the impact of an inverted yield curve, it is expected that in 2024, we will witness banks' cautious attitude towards lending intensify, further weakening the demand for labor and slowing down the economy. Traditionally, banks operate by borrowing at short-term interest rates and lending at higher long-term rates, profiting from the difference between these two rates. However, in the case of an inverted yield curve, where short-term rates are higher than long-term rates, the net interest margin for banks is compressed. This situation has existed since July 2022, and against the backdrop of a slowing economy in 2024, with overall higher interest rates, banks' cautious approach to corporate lending is expected to increase. Subsequently, in the fourth quarter of 2023, the ABA Credit Conditions Index indicated that internal economists in banks generally believe that the state of the credit market will deteriorate further in the next 2 quarters. Therefore, closely monitoring these 3 key trends of the US economy in 2024 is very important. I believe that the issues and trends mentioned above are not about whether they will happen, but when and how severe they will be. If these issues deteriorate faster and more severely than expected, the US economy is likely to face the risk of a hard landing in the 3rd to 4th quarter of 2024. This contrasts sharply with the current market's extremely optimistic expectations for the economy and is likely to have a significant impact on the stock market. Do not expect the Federal Reserve to act with foresight. History has shown multiple times that the Federal Reserve can solve problems but is unable to prevent them from occurring. Generally, it is either too late to raise interest rates or too slow to cut them.
Thank you so much for watching. See you next time.